Hey traders, Gavin McMaster here from Options Trading IQ, and you might have heard a lot of myths about options trading. Well, today we're going to set the record straight with option trading myths debunked. Just a quick reminder that everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. So myth number one, options are risky. Yes, options can be risky, but they can also be used strategically to manage risk. It's all about understanding the strategies and starting small. Learning the basics can make options a powerful tool even for beginners. And did you actually know that options were first created as a risk management tool? And I'm going to show you exactly how they were first created and their purpose. So let's say we have a portfolio and we have 100 shares of SPY, just going to keep it fairly simple. It's about a $60,000 portfolio. And if the SPY goes up, we make money. If it goes down, we lose money. Now, options were first created to protect the downside. So via put options, we can come in here, bring up our options chain, and we'll go out roughly 6 months or so, go out to June, and we're going to buy an out of the money put option at say 570. So that put option is going to cost us about $1,200. And if we look at the change in our payoff graph, our losses are now capped below 570. We've reduced our risk. So that's a really simple method for using options, is as a protection mechanism for a portfolio of stocks. Now, obviously, this is like buying insurance. There's a cost to that insurance, and that could end up being a drag on our portfolio. If the market doesn't drop, we would have been better off without the protection. But sometimes it's worth having that little protection in place just in case the market does go through a correction or a major crash. Myth number two, options trading is gambling. Unlike gambling, options trading is about informed decision making. Successful traders analyze market trends and use strategies to hedge risk and have a plan. It's not about luck, it's about skill and research. Myth number three, only experts can trade options. You don't need to be a financial expert to trade options. With the right education and practice, anyone can learn the ropes, and you can make things as difficult or as easy as you want. You can stick to just simple strategies and be quite effective trading options. You don't need to go overboard with all these complex strategies and analysis. There are plenty of beginner-friendly strategies like covered calls and cash-secured puts to get you started. Bull put spreads as well, so credit spreads are another great place to start, which we'll look at shortly. Myth number four, options require a lot of capital. While some option strategies can be capital intensive, there are many that don't require a huge bankroll. Bull put spreads, for example, can be done with smaller accounts. And let's take a look at an example. So if we go back to our risk navigator, we're going to use the NASDAQ this time. And we're going to say a 25 delta bull put spread. So we're going to sell the one that's closer and we're going to buy the one that's further away. Change our expiration date. And now we've put on a trade here with maximum risk of $400. So you can do this trade with very little capital. And this is a great way to get started. You could even do this with less capital if you put the strikes closer together, if you want to just do like a little test trade. Now, the other option, if you're bullish, would be a bull call spread. And again, we'll go to about the 25 delta. So in this case, we're going to buy the one that's closer and sell the one that's further away. We've gone out to a further expiration date. And now in this case, our maximum risk is only about $130. So you can do options trading with very little capital. So that is a complete myth that you need a lot of capital to trade options. Myth number five, options are only for short-term traders. Options can be used for both short-term and long-term strategies. Leaps, or long-term equity anticipation securities, allow traders to hold options for up to 2 years, making them suitable for longer-term investment plans. So buying leaps is a great strategy to get leverage in the market, and these will do really well during a bull market and provide significant returns if your stocks do rally. Myth number six, options are too complex. Options can seem complex at first, but once you break down the basics, calls, puts, and the Greeks, they become much easier to understand. As I said earlier, you can make things as simple or as complex as you want, but sticking to very basic strategies like covered calls, you can't go too wrong. So start with simple strategies and build your knowledge from there. I would suggest covered calls are probably the easiest one to start with, along with cash secured puts. And then from there, moving on to vertical spreads like bull put spreads, bull call spreads, that sort of stuff. Myth number seven, most options expire worthless. As an options seller, this myth works in your favor. Some options do expire worthless. That's actually the goal for option sellers. You keep the premium without having to fulfill the contract. But in truth, most options are closed out before expiration. Myth number 8, you need to predict the market perfectly. Options trading isn't about predicting exact movements, it's about managing probabilities. You can profit even if the market doesn't move as expected, depending on the strategy you use. For example, with a bull put spread that we looked at before, you can profit if the market goes up, if the market stays flat, or even if the market drops slightly. So there's a lot of flexibility with options, and you don't need to be perfect with your market direction. Whereas someone who is a long-only stock trader, they basically need the stocks to go up, and that's the only way they can make money. Myth number 9, selling options is more dangerous than buying. Selling options can be risky, but it's not inherently more dangerous than buying. Sellers collect premium upfront and use strategies like covered calls or spreads to limit their risks. Myth number 10, options are only for speculating. Many investors use options not just to speculate, but to hedge against potential losses or generate income. Strategies like protective puts and covered calls can provide safety and steady cash flow. In conclusion, by understanding and debunking these myths, you can approach options trading with more confidence and clarity. Make sure to check out all the resources in the description below. Reach out anytime with questions and have a great day.